Hello again, and welcome back to Perfect Spiral Capital. My name is Luke Tatum, and I am so glad that you are here choosing to spend your valuable time with me. Today, I want to talk about the downsides to IBC, or the infinite banking concept. We life insurance folks are often accused of only talking about upsides. What are the downsides? I can't believe this. This sounds too good to be true. What are the downsides? Okay, well, if you've read Becoming Your Own Banker by Nelson Nash, the author of that book, who himself was a life insurance agent once upon a time, he would say the downside is missing out. The downside is not participating. But I want to give you a little bit more complete answer. You need to choose what angle you're looking at this from. If you're talking about life insurance, which we are, but if you're just thinking about how can I efficiently spend my money to protect my family, I want to have the most death benefit, the check that would be payable to my beneficiary, to my spouse, my children, etc., if something happened to me prematurely. Well, from that standpoint, you would look at a dividend-paying whole life insurance policy from a mutual company, which is what we're working with, and you might say, wow, that's a lot of money. That's very expensive. Okay, let's take that apart just a little bit, because you do have options when you're getting life insurance. You may have heard of term life insurance. You may have heard of universal life insurance. You may have heard about mortgage protection plans. You might have heard about survivorship policies, et cetera, et cetera. There's a lot of words. There's a lot of jargon, industry terminology that gets thrown around when it comes to life insurance. But if you think of a term policy, which is probably the most commonly understood type of insurance, think about, say, a 1-year term life insurance policy. So you want to insure yourself for $500,000, and you want to do that for 1 year. And let's say you're 30 years old. That's not going to cost very much money, because the only thing that that life insurance company is on the hook for is to pay that death benefit if you pass away within a 1-year period of time. What is the likelihood of a 30-year-old male, let's say, passing away within a 1-year span of time? Well, it's not very big, unless you already have some significant issues, health challenges, etc., that are probably going to prevent you from getting the policy at all, right? They probably would decline you if you have some major health risk already at that time. So, okay, I mean, they might not even write that policy in some cases because the risk is so low. What premium do you charge for that? $10, right? It's not a big risk for the insurance company. But if you extend that out and say you want to get a 10-year term policy, well, you pay the same premium for 10 years, and in exchange, you will receive that coverage, that protection for 10 years. You could do 15 years. You could do 20. Some companies offer 30-year term policies. And for that duration of time, you're covered. But let's break this down a little further. So, do you think that a 30-year term policy might cost more than a 10-year term policy? Yes, right? Right? Because they're insuring you for a longer period of time. Okay. Well, how about a whole life policy? What is a whole life policy? Well, a modern whole life policy is insuring you until you are 121 years old. So, do you think that if you took a 10-year term policy on a 30-year-old and you extended it from 10 years all the way to 50 years, 60, 70, 71 years, you might start to see some increases in price, right? Right? That's effectively what a whole life policy has done. It's extended it all the way out to age 121. And so what does that mean for you? Well, that means that the life insurance company must, at some point, pay that death benefit. If it's a $500,000 whole life policy, you bet it's going to cost more money than a term policy. But because it's what's called permanent insurance, it's also known as ordinary life insurance, because this was the original form that life insurance took many, many years ago. Well, you get some extra benefits with that. There's cash value that you can use, and there's some very, very advantageous ways to deploy that. You get coverage without having to go through an underwriting process ever again for the rest of your life. If you happen to live all the way to age 121, guess what? They pay the entire death benefit check to you while you're still alive because the contract is over. And that death benefit, if it's dividend participating and is reinvested, it's going to be very large by the time you're 121 years old. So it's kind of a cool idea, right? And so what explains the difference in price? Well, the duration of time explains the difference in price. How about universal life? What's the deal there? Well, universal life is the idea of a term policy for 1 year, and then it reprices every year. So when you're 30, it's cheap. When you're 31, it's cheap, but not as cheap. When you're 36, it's a little bit more. When you're 50, it's a lot more. When you're 70, it's very, very high compared to what it used to be. And so it's going to continually reprice every year. Reprice. And so when you actually have a high likelihood to pass away, when you are at the end of your life, if you've lived a long, natural, healthy life, you probably will not have any death benefit left or any cash value left. The policy will cannibalize itself. It will eat itself up. The cash value will drop to zero, the death benefit will drop to zero, and it will be gone. You will have no life insurance coverage, even though you've paid in for a very, very long period of time. And so what is the downside of the dividend paying whole life policy? Well, it's got a higher premium. It will cost you more than those other two options would cost you, other things being equal, to get started with the whole life policy. In exchange for that, you get a guaranteed level premium policy. The price cannot increase under any circumstances, except unless you tell it to, unless you add coverage or something like that. So you know up front what your cost will be. That means the insurance company is taking on the risk. They have to make sure that they are pricing their product appropriately. You get the benefit of that and the dividends and the other things. So I'd say that's the first major downside of infinite banking. It's expensive. For the same amount of coverage, it will cost you relatively more, generally speaking. What's the other downside? Well, looking at it from a different angle, people will often want to compare this to an investment. They'll say, well, I understand that the cash value in my life insurance policy is going up, and that looks cool, but couldn't I make more money if I just put it in the stock market? If I put it in a Roth IRA or my 401k or et cetera, et cetera. There's a lot of different ways you can play the stock market, right? Or shouldn't I just buy real estate? That's sometimes an objection. Well, okay, if you want to look at it from a strictly rate of return point of view, you may have some red flags. You might say, well, okay, but here's the thing. A whole life insurance policy is not an investment. It is a safe place for your money to exist and grow. It's what Nelson Nash would have called a warehouse for your wealth. And this is a place that you already know what the expenses are because it's a guaranteed level premium. And you already know what the dividend history for the company is. A lot of times it's 100+ years of consecutive dividends. Not a whole lot of stock market companies that can say that. And you already know what the terms of using that money are, right? You've got access to policy loans. There's plenty of videos on this channel, and we have a course on our website talking about how that works and how to use them. You've got access to money, and you've got the ability to deploy that money to do anything you want without a credit check, and at the same time, earn a gradually growing dividend. So is that a worse rate of return? Couldn't I put the money in life insurance and then use it to buy an investment and get both the investment return and the growth inside the policy? Yes, but this is the other major downside. You have to think through this. You have to set it up. You have to grapple with the ideas. You have to change your thinking a little bit and unwind yourself from the obsession with what's the rate of return. Because if you focus only on rate of return, you'll end up focusing on rate of return. You're going to end up looking for what is the biggest number I can get next to the percent sign instead of looking at the fundamental relationships between the assets that you have. You can do both. I don't want you to miss high rate of return activities, but the best way to get into opportunities with a high rate of return, the best way to capitalize on once in a lifetime opportunities is to have capital. It's to have readily available money set aside, growing, and ready to go. Where's the best place to do that? I would say it's in a dividend paying whole life insurance contract. That's where I keep my money. So those are the two major downsides. You've got the rate of return question. Shouldn't this be an investment? Shouldn't I make a higher rate of return? Shouldn't I look for S&P 500 index rates of return on this? And then you've got the cost of insurance downside. Those are both explained by the characteristics of the contract. And that's what I love about this. There's no obvious major real downside. There are only trade-offs. And if you understand why those trade-offs are desirable, you've got it all figured out. I hope that helped. If you have any questions, please reach out to us. You can find a whole lot more information about the infinite banking concept on our website, perfectspiralcapital.com, including an 11-video course on the subject for free. Thanks so much for watching, and I'll see you in the next video.